we've created something over here. So we've monetized the house, or we've accessed housing wealth, even if that means paying off an existing mortgage. But we're going to create something over here that will be more substantial in the future, going to give you greater longevity, greater legacy, greater lifestyle and enjoyment. And I think you said it in the beginning, to enjoy retirement. No one wants to be dreading the day when they see their last dollar.
Markets go up and markets go down. It's hard to predict anything in the modern world, yet you are ultimately responsible for your livelihood, investments, and retirement. Where do you find the answers? Joshua Melberg, author, TV host, and the founder and CEO of an independent financial services firm that specializes in retirement income planning and is licensed in all 50 states and has received numerous industry awards, will help you navigate the modern world's rough waters. Join us now on Mastering Your Money, Ways to Maximize Your Income.
Hello, I'm Joshua Melberg, and welcome to Mastering Your Money, the show each week where we explore strategies that can add security and enjoyment to your retirement. Whether you're preparing for a future retirement or you've already retired, it's important to focus on mastering your money. And at the end of the day, it's about the net. Net of the taxes, net of inflation, and net of fees. Mastering these and you'll have more fun, more time, and more money. When you retire, you want to start smart and finish strong. And the equity in your home can be a great way to do this. On today's show, we are going to focus on some interesting and clever strategies for using reverse mortgage in retirement income planning. To help us, we have a special guest. His name is Don Graves, principal for the HECM Mortgage Advisors Group. Don has helped thousands of people with reverse mortgages. What may surprise you today is that affluent retirees are using reverse mortgages along with some advanced strategies to combat stock market risk, reduce taxes, and get more from their Social Security benefits. Welcome, Don. Thank you for joining us today.
Thanks, Josh. Great to be here.
So what's new out there? There's reverse mortgages, there's normal mortgages. How does that work, and how does that apply to the viewers?
Sure, most people have seen or heard or read something about reverse mortgages, and they may have varied opinions. It reminds me of a client. They had retired well, they were 62 and 65, they had over $500,000 in savings, and they got a reverse mortgage. And they told their friends about it, and the look on their friends' eyes were, oh my goodness, Bob and Jenny, not their real names. What happened? Did their advisor lose the money? Did they fall on hard times? And there was all of this perspective. And they told them, no, the reverse mortgage is a lot different than you may have imagined. And that's what's happening. And it's 27-year history since becoming being insured by the federal government. A lot of changes have occurred, and I'm looking forward to sharing some of those changes and really the strategies that are helping increase retirement success outcomes.
So what you're saying is there are people out there that have money and they consider reverse mortgage. So can you tell us a little bit, how does a normal mortgage work? I think most of us know how that works. You take a loan and over 30 years you pay it back, even though most people don't live there for 30 years. But what is a reverse mortgage and what makes it different? Sure,
and you mentioned two things. Typically when an advisor or someone talks to their advisor about a reverse mortgage, they'll hear four common misconceptions. It's too complicated, it's too expensive, it's a last resort, or it's going to not leave anything for your children. Very common misconceptions and misunderstandings, but it's too complicated as often. And I say to folks, well, you understand how a mortgage works or home equity loan. You go to the bank, you qualify, and money is made available, and you make a monthly payment. A reverse mortgage is simply a mortgage with a different repayment term, namely that there's no repayment required at all. So you go and get a reverse mortgage. You can establish a line of credit, draw from it when you need it, but now there's no monthly mortgage repayment required. The loan gets repaid when the last surviving borrower permanently departs the house. What gets repaid is whatever money was advanced to you, plus the interest that accrues. That gets repaid, and 100% of all remaining equity passes on to you in the case you move, or your heirs, or your estate.
So Don, I'm a terms guy, and I always look at what are good terms and what are poor terms. So maybe you call in CDs were 10% a year, and now they're like 1 or 2% a year. Now it seems like you can get a mortgage on a house for very low interest, and people are getting 30-year mortgages, which is pretty traditional, 15-year mortgages. But most people's mindset, I know that's how mine was, is I'm going to pay off my house. And I may not want to retire until I pay off my house because I don't want those extra payments in those payment bills. So most of the time, you're paying down your house, and as you pay down your house, you have to pay interest and principal, and that interest is tax deductible. But you're saying the reverse mortgage essentially is if you're qualified, and you'll tell me the terms. I think you have to be over 62, and you have enough assets in your house, you don't have to make any more payments.
Correct.
But how's that possible? That sounds kind of too good to be true, or there must be some astronomical cost to that.
Sure. The cost of reverse mortgages have decreased substantially over the last 4 years, in some cases down to absolutely zero cost to establish a line of credit. So the interest rates are comparable to a traditional home equity line of credit, but here's the significant difference. A reverse mortgage, you're not making any monthly mortgage payment. Now think about this. The baby boomers and those in retirement, 87% of baby boomers are going to come into retirement owning their own home. 68% will be carrying a mortgage on them. Simply stated, that housing wealth, which a reverse mortgage is, it's just accessing a part of your total wealth, we call it housing wealth, is something that cannot be overlooked. And so people may have seen something in one dimension. I see the reverse mortgage, it's only for poor people, Mrs. Jones has cut her medicine in half. Or
So most people do it only for last resort because
typically that's how it's been promoted.
I remember some people telling me, it says, I don't want to do reverse mortgage because if I do, the bank owns my home, I don't own it anymore, and when I die, the bank gets to keep it, and I want control. And so maybe that's how they were back in 1968 when they started. But since the government is insuring these reverse mortgages to some type of degree,
right,
and traditional mortgages you spend down until your house is paid off. Here's the challenge that I see with people that want to retire. A lot of times they have $100,000, $200,000 that they have to pay down towards their house. But you might have $600,000 property or a $500,000 property, but there's equity in that property.
right.
But a lot of people are saying, I want to retire, I can't retire, or if I do retire, I don't have a lot of money because I have a $1,500 payment between principal interest. And so how does that reverse mortgage fix that if you're over the age of 62 and you have enough equity in your home? Does their credit apply to that?
Sure. So the reverse mortgage, and I think for the listeners, if you understand it as simply a mortgage,
Okay.
that takes all the mystery and spookiness out of it. You have to qualify, their income qualifications, their credit qualifications. That's fairly new since April of this year. That hadn't been
Okay.
the case. So you qualify in those to make sure you're a good candidate for this, because we don't want to put people in them that are not the right fit. And so now you're able to borrow money. The amount of money you get is based off of your age. The older you are, the more money you get, the value of your home, and the current interest rate.
Okay.
So let's use an example
Sure.
of a client that's got a $400,000 property, but they've got a mortgage on it, and that mortgage is $1,500 a month, giving your example.
Sure.
And they're in retirement. Now their retirement cash flow is impacted by $1,500 a month.
And that's spendable dollars. That's money that you physically leaves from your bank account, which might mean you might need to create $2,500 or $2,200 of taxable money to net the $1,500 of spendable money to pay that mortgage.
That's right. So they decide, I'm going to swap a traditional mortgage with a reverse mortgage. So they swap. So now in the reverse mortgage, let's use a $400,000 house, and just for example, 50% is available through a reverse mortgage, or $200,000. That $200,000 first pays off their existing mortgage, assuming it's less than that number. Now we've done a couple of things. Now we've freed up $1,500 of spendable money.
But they still have a loan for $200,000 if the house is worth $400,000. They still owe that.
They still have a mortgage,
Right.
right? Now it's a reverse mortgage. One they were making a payment on, that's impacting cash flow. Now they've swapped with the reverse mortgage.
Okay.
There's still a mortgage, but this time there's no monthly mortgage payment required. And as a financial professional, particularly in the retirement income phase, having $1,500 freed up in cash flow, you can do a lot of different things that increase their outcomes.
So just looking at the screen here, a traditional mortgage, you're on your way paying it down. But if you're in retirement, paying it down could mean 15 years or 20 years of less cash flow that you can depend on, or it might mean you have to work longer.
Sure.
What you're saying is a reverse mortgage is kind of the opposite, where you don't make any more payments. You probably still have to pay taxes or homeowners association fees, but you don't make any more payments for principal and interest.
Correct.
But your loan actually goes up, but you still don't have to make payments.
That's right. So your loan balance is going up.
Okay.
But if you use it strategically, when you've done that, we've created something over here. So we've monetized the house, or we've accessed housing wealth, even if that means paying off an existing mortgage. But we're going to create something over here that will be more substantial in the future, going to give you greater longevity, greater legacy, greater lifestyle and enjoyment. And I think you said it in the beginning, to enjoy retirement. No one wants to be dreading the day when they see their last dollar and they're still alive.
And it's the spendable dollars. Now, what happens if that loan becomes more, you live too long, that loan is worth more than your house, or your house value goes down?
Sure.
How are you protected?
Sure, that's the difference. In 1961, the reverse mortgage started in America, in Portland, Maine. 1988, it became part of the federal government, and that FHA began to insure the loan. And what you just described was part of the difference between 1961 and 1988, that it's federally protected. So you're never going to be required to repay more than the home is worth, no matter how long you live, no matter what your home did in value. So if you live to be 121 years of age, your reverse mortgage balance is here, but your house value is here. And you say, oh gosh, now I owe more than the home is worth. Because it's federally insured, all the lenders able to recoup are the net proceeds from the sale of the house. There'll be no deficiency judgment taken out against you, your heirs, or your estate. So everyone's protected.
So Don, unfortunately, I've actually seen people where they have to sell their house for rent money, and it's because it's a cash flow issue. They don't have enough money to continue to pay and make ends meet. Life gets more expensive, inflation keeps happening, and so a lot of people do it for last resort, and they know they don't have to make those payments anymore for the principal and interest, but that mortgage can go up. Now, the good news is interest rates are all-time low. So what kind of loan would your loan go up by in today's rates range?
Sure, and I think when we think strategically about reverse mortgages, someone says to me, Don, what's changed? And I said, let me tell you what's changed. I've been doing it 16 years coming up on. And when I would talk to advisors in the early days, they would say, in essence, Don, I would only tell my client about this when pigs fly. Now, my family's from Kentucky, so I've seen a pig fly, and I don't think my cousin and I should have done it.
I've lived there for a few years myself, yes.
Or, Don, we're only going to recommend it as a last resort.
Yeah.
Well, this strategy was really taken to academic task in around 2012.
Okay.
The Financial Planning Association and others like them began to say, is that really true? Is the best use of a reverse mortgage for those with assets to use it only when they've spent down the assets? And so Dr. Barry Sachs and his brother Stephen Sachs did the research, wrote a paper called Reversing the Conventional Wisdom. That was published in February of 2012. And it said this, as an advisor, if you've got people with assets and the prevailing thought is, well, we're going to begin drawing on these assets at a certain time, how much do we need to draw for this to be sustainable? 4% has been typically the well-accepted rule. And so what the Sachs brothers did is said this, if a client takes out their money drawing out at 4%, given all types of scenarios, what's the chance that they're going to have that money last 30 years? And they did that.
Sure.
And then they added a reverse mortgage to the equation. They said, now, given three choices, use a reverse mortgage as a last resort, use it as a first resort, meaning set up a reverse mortgage line of credit and draw from that first before you ever touch your savings, or what they call a coordinated approach, and I won't talk about that.
So let me make sure I'm understanding. There's two types of people that look at reverse mortgages. One is, okay, if I have to, and I love where I stay, I want to stay where I'm at, I don't want to sell my house for rent money, that's last resort. Some people look at reverse mortgage for that reason. You're saying there's also people that have monies, they have IRAs, they have 401ks, and there's this 4% rule that people used to talk about where, you could take 5% a year out or turn to 4% a year out, and you shouldn't run out of your money.
Sure.
Well, today's economy, interest rates are rock bottom. CDs are 1%, treasuries are very, very low. And what they're saying is you could probably take closer to 2.7% out per year.
Right.
And that's not a lot. So if you don't do that, you only have a 92% success rate at 2.7%. And that doesn't make me feel very comfortable. I mean, you're flying back to Philadelphia, and if I told you have a 92% success rate of getting home okay,
Right.
that you might not feel very comfortable getting on that plane. So what you're saying is people that have money are actually utilizing the reverse mortgage, but they're not taking the loan necessarily, right?
Right.
They're just locking in access to the money.
Correct.
Right? And tell me quickly how that works. How do you lock in access to the money? You get a reverse mortgage, and how much does it cost?
Sure. So your viewers used to going to the bank and setting up a standard line of credit. They qualify. The bank says you've got a home equity line of credit of X dollars. Same with the reverse mortgage.
Okay.
And
$400,000 house.
$200,000 line of credit.
$200,000 line of credit.
Right.
And it's a standby line of credit. That means it's guaranteed. They can't take it away.
Can't take it away. Can't
Okay.
be frozen, canceled, or reduced.
So a lot of other home equity line of credits could be taken away, frozen, or reduced.
That's correct.
Right. But a reverse mortgage, standby reverse mortgage, $200,000 cannot be reduced or frozen, and it's guaranteed as long as you live in that home.
That's right. And it's guaranteed to grow.
And it's guaranteed to grow.
Right.
Tell me about that.
Well, one of the things, I was at the Center for Retirement Research at Boston College. I was able to interview did a presentation, interviewed 7 people. 6 of them had PhDs. Out of the 7 people we interviewed and said, after you've seen the reverse mortgage, what surprised you the most? 4 of them said that the line of credit actually grows. It's guaranteed to grow. It grows regardless of the home value. They said,
And what are you seeing out there? What does it grow by?
right now it's growing at about 4.5%, somewhere in that range. And
So if I'm doing my math, you don't even need the money. Okay, we call it sleep insurance. It's just like an insurance policy if you do need it, because they can't ever take it away, just in case something happened, which might give me more peace of mind. But if it grows by 4.25%, and you have a $200,000 access to a line of credit, doesn't mean you're borrowing it. Doesn't,
Right.
And then you'll tell me about the costs in a second. That means after a year you have access potentially to $209,000.
That's correct.
Or over a 15-year period, you have access to $400,000.
Sure, absolutely.
Okay, now what's the cost? Because what I've seen, the older types of reverse mortgages, people are like, it's the last thing I want to do. They're expensive. What's the cost that you're seeing out there for standby line of credits?
Yeah, and Josh, I've been doing this coming up on 16 years, so I've seen price fluctuations just like you. Interest rates go up or down. And I've always answered the question this way, Don, these are expensive. And I'd say to the person, compared to what? What are you comparing this to?
What are some rates? What's the old rates and what's the new ones?
And when I say that, what are you comparing it to? What I'm saying is, if this strategy allows you not to run out of money and to actually have $1 million left over because we employed the strategy, the costs are determined by the benefit. Having said that, the cost of a reverse mortgage have been reduced significantly since 2012. Given the example you just stated today, a $400,000 home that sets up a $200,000 line of credit can be anywhere from zero closing costs to a few $1,000s. That's significantly different than 12 or 14,000
I've heard 12 or 14 in the
from
past.
years ago. No, so there's a drastic change.
And here's what I'm taking away from it. Even for people that have money that may not need money, but it gives them access to money, and we'll show a couple quick strategies that people are enforcing here. It's not $14,000 just to have access to $200,000.
That's right.
Right, and the government just can't just take the home away, and you don't have to use the money. It's not like your loan keeps growing if you don't use it.
That's right.
But for a couple $1,000s, you could have access to a couple $100,000, and that money is guaranteed to increase
That
to
is
have
correct.
more access to money, depending what kind of standby line of credit program you get.
Absolutely.
Now, quickly, this is interesting because one of the biggest mistakes retirees and boomers are making these challenges, these issues where when the markets do have corrections, they take withdrawals out of their 401ks, they take withdrawals out of their savings, and it's called asset erosion. And I have a quick chart here that just shows $1 million balance. Let's just say it's an IRA 401k, and they want to take out and spend a net $50,000 a year. But if you need $50,000 a year, you really need to pull $75,000 a year out of your 401k IRA because you have to pay taxes to the IRS.
Correct.
So your spendable is $50 to supplement your Social Security. Well, the challenge is if we have a correction like we had in 2008 and it dropped by 38%, and you're pulling $75,000 out of that 401k IRA and you have to pay taxes on it, you have a balance of $490. But in this case, what you're saying is, even if you don't need the money because you think you have it for a couple $1,000s, you have access to money that's guaranteed that you can't take it away.
Right.
And this other example would be when the markets did crash in that 2008, instead of pulling money out of that IRA to continue lifestyle, you just access the standby line of credit.
That's right.
And because it's tax-free, it's not taxable, you only needed $50,000 to net your $50,000.
That's right.
Which is a very clever strategy.
Absolutely. A stunning strategy, and one that most advisors nor their clients understand.
Yeah.
That the most dangerous thing, as someone said to me, 2/3 of the people who died coming down, climbing Everest, they die on the descent.
Right.
Accumulating money is one thing. As you begin to withdraw it, there's 16 risk factors that can erode and cause your plan to absolutely collapse. Sequence of returns risk or wealth erosion. All it takes is 2 years of the market being negative as once you start drawing that in the early years, and you're going to run out of money most of the time. If you're able to not draw, but set up this standby line of credit and draw from it, you put yourself in a much better situation.
It seems like it's a relatively inexpensive insurance policy. Now, one strategy that I can kind of see right now, a lot of people don't have enough spendable income. And one clever way of using this, for a couple $1,000s potentially, you have access to potentially $200,000 depending on how much your equity in your home is.
Yes.
And you're getting to the point where you want to retire, you're 62 years old, or you want to retire right around that range. But if you turn on Social Security at 62, then you're not going to get that much. You might get $1,500 a month, you might get $1,000 a month. But if you were to use your standby line of credit to live off of, and you use your Social Security optimization strategies, depending if you're married or not, you can double your paycheck with Social Security.
Absolutely.
And if your income goes from $1,500 a month to $2,000 or $3,000 a month over 8 years,
right.
That's a lot of money of spendable dollars, and all that money you pulled out is tax-free, and then you have a tax deduction, and that $3,000 a month, if you want, you could always use portion of that money to pay it back down.
Sure, that's fantastic. 10 years ago, no one was talking about Social Security deferral or optimization. Now, every retiree has to look at that very seriously to say, if I defer to 66 and 67 and do a file and suspend strategy, or clearly the 70. But how do I bridge the money I may need from 62 until here? And you've just explained it. You can use a standby reverse mortgage line of credit, fund whatever that gap would be, and now you're going to double your ability to maximize or optimize your Social Security.
What I see, Don, is at the end of the day, it could be a tool, and it's about the terms. If it's going to cost a lot and it's not good terms, you don't do it. If it costs a small portion and you can see it to utilize to optimize or maximize Social Security, to help protect yourself from a market correction, maybe it just helps you sleep a little bit better at night because you have access to money. And everybody needs to feel like they have access to money. And what I like about it, that it's guaranteed it can't be taken away because the government's reinsuring it. You still have to pay your taxes, you still have to pay your homeowner's insurance, but it's all about the terms. That's what I'm walking away with. It's about the terms.
The government is sponsoring it. It's under the HUD, but it's not taxpayer dollars. So in the example, Don, what happens if Mama lives X number and her house is now only worth $300, but she owes you $400,000, whatever? She's upside down. What happens? I said, well, because it's an FHA insured loan, FHA. So everyone who gets an FHA loan pays into a risk-sharing pool. So it's not taxpayer funded; it's consumer funded. Those who actually took the loan out.
That makes sense.
So we don't want people to get upset saying that's my taxpayer dollars. No, it's funded. It's self-funded and self-sustained.
Well, Don, thank you so much. A lot of interesting strategies that we could use here. Tax-free, sponsored by the government, access to money, can create greater peace of mind. Thank you.
Yes, sir. Thanks, Josh.
When you retire, you want to start smart and finish strong. And here's some final thoughts that might help you accomplish this. Number one, if you decide a reverse mortgage is right for you, things have changed rapidly, and it comes down to the terms. Meaning if they're expensive, don't do it. If it's low cost for your particular situation and you have access to guaranteed money that can't be taken away from you, it might be right for you. And for the example we used, if you're drawing from your savings to supplement your retirement and there is a correction, this can be a great strategy to pull from tax-free if needed for a year or two, and then potentially pay it back. Number three, if you need to maximize your income in retirement, if you think you want to optimize your Social Security benefits, this can allow for you to retire sooner by using a standby line of credit with a reverse mortgage to supplement your income, double your paycheck with Social Security benefits, and if you wish, you could always pay it back. It's all about the terms. Remember, it's about the net of fees, net of taxes, and net of inflation. Master these and you'll have more fun, more time, and more money. I wish you success, and I'll see you next time. Now go and master your money.